Hi, everybody. Jeff Yastine here, and I'm joined by my colleague and friend, Ian King. Ian, welcome.
Hey, Jeff. How's it going?
It's going well, and I guess I should ask the same for you, especially with this coronavirus spike that we're beginning to see in the last couple of weeks. And I know in our part of Florida, they're now closing all the beaches ahead of 4th of July and all that. And I know it's cast a pall a bit over the markets, especially on Friday. And I'm curious to see what happens this week. What do you think?
Yeah, we've really started to see the markets pull back on coronavirus. It seems like every day around noon is when these states release their daily totals, and the numbers in Florida, Texas, and Arizona, and Georgia in particular have been growing exponentially. I think in Florida, our daily cases has doubled in the last week. So a week ago, we were reporting about 4,500 to 5,000 cases. Now we're in the 9,000 range. So the market obviously doesn't like this because they're worried about the economy being shut down again and having to go through the same thing that we went through in March and April. And I can see a reason why people are selling stocks. So yeah, it makes sense. I don't think that we're going to drop back down to the lows that we saw in March, because I think back then there was a lot more uncertainty about how this would play out. Now we know that the case fatality rate is low and actually might be lower than we think. The CDC last week said that there could be 10 times as many cases in the US already than was previously reported. So that's going to bring that case fatality rate down a lot lower. And I think it's going to encourage people to open up the economy a lot faster than expected. So if there's any silver lining in these numbers or the data we've seen, it could be that this is going through our country faster than we had anticipated.
Ian, so let me follow that up with another question here. Is the concerns over COVID-19, is that enough of a reason not to buy stocks, in your opinion?
Well, I mean, I think we saw a lot of speculative activity in the last month, which we noted in these Market Insights webinars. We talked about Hertz, a bankrupt company, people buying the stock at 40 cents and it going up 10x. We talked about Nikola, which is a Tesla competitor that doesn't even have a truck, which is a $20 billion company. So you're seeing a lot of speculative excess. What I'm looking for right now is a kind of washout of all the speculative excess. And it happens in these bull market rallies where it never goes straight up. And there's always kind of a shakeout before the breakout. So I think we're going to have a correction here, whether it be maybe 10 or 15% from the highs. And then I think the market's going to continue higher later this year. You could also call it a dip then rip. It shakes out the weak hands per se in the market and then allows the market to go higher. The number one thing I'm still focused on is the fact that there is so much growth in the money supply right now. M2 has accelerated faster than it ever has in history because of the $3 trillion fiscal stimulus and the $4 trillion that the Fed has added to banking reserves. And I think that is going to power the market for the next couple of years, even though we might be facing a pullback here in the short term and perhaps even the medium term. Maybe this pullback lasts a couple of months, but I think in the longer term, you just cannot fight the Fed. And this is still a bullish sign for the markets. How about you? What do you think about that?
Yeah, I would agree with the broad outline of what you're talking about with the Fed, all those sorts of things. It pays not to get too bearish simply because you're just going to be waiting for stocks to fall. And we may never get that huge pullback that some people may be looking for. I think the other thing that's going on in the background here is something I've talked to my subscribers about before, which is just the idea of rotation. A lot of the leader type stocks, I think we're starting to see more selling in some of those. And a lot of those are the big, tech stocks, FANG, Facebook, Apple, Amazon, Netflix, Google. And again, not that they necessarily fall all that much, although I think Facebook dropped like 7% on Friday and 2 or 3% more this morning. But I think that may just be an example of money coming out of those big giant growth stocks that in many cases are at high valuations, and the money moving on to other places where the values are basically on a more viable basis, not just for now, but for a year and 2 years from now. So, I think it pays, as you were saying, yes, be cautious, be smart about what you're buying, but it doesn't mean that you have to go run for the hills and go hide in your bunker. There's always stocks that you can buy You just have to choose wisely.
Yeah, I'm glad you brought up the tech stocks because, this is not your dad's tech stock rally. If you want to compare this to .com, back then the NASDAQ was trading about an 80 forward PE, and right now the NASDAQ is about a 25 forward PE. So the valuations here are not as extreme as they were in 2000, and because a lot of the market weight is concentrated in big cap tech like Facebook, as you mentioned, Apple, yes, Microsoft, Google, all the FANGs. And so I think that we have to be really careful about saying, oh, these stocks are wildly overvalued, because there's just been this kind of winner take all phenomenon in the last decade where if Microsoft and Apple aren't buying all their competitors, right, there is no competition, and they're kind of sucking up all the business in their specific industries. Facebook and Google in terms of social media and advertising, Apple in hardware sales and services as well with the App Store, and Microsoft now as a cloud company. So I think there's a lot of differences between what tech was 20 years ago, where we're like, oh my God, this is so overvalued because the market's up, and where it is now, where it's pretty attractive for the next 5 years or so if you think that these stocks are only trading at a 25 PE. And also with low rates, and the way the world is moving now with coronavirus is everything is going to the cloud, and tech adoption is accelerating, whether it be through e-commerce or logistics or people working from home. So I think that tech right now is still the place where you want to be investing in the next decade, and it still looks reasonably attractive to me. And that's not to say, one last thing, there are some cloud stocks out there that are trading at like 80 times earnings. There's a handful of them, whether it be Okta or Shopify or Wix, and these stocks are just in the stratosphere right now. Those are the ones I would avoid, because I think if we have a pullback, they'll fall the hardest. But I still think overall the NASDAQ with a 25 price earnings, NASDAQ 100, is still reasonably attractive. And so
I wouldn't disagree at all with that. I think it's just a matter of, if you look at just individual specific stocks, as you're mentioning, there's plenty of good values out there on an index basis. It makes sense. But at the same time, there's just some stocks that have just gotten run up really high to, extremes of valuations. I've written a few pieces before about, in my view, Microsoft, extremely overvalued, Facebook, extremely overvalued. It doesn't make them bad companies. It just basically means that, if they fall 10, 20, 30%, they're going to make better buys than they are, say, a week ago when everybody was buying them and it was just considered to be, the stock that you had to own. And this is just typical. So, like we always talk about with markets having corrections, sometimes it's a price correction, sometimes it's a time correction. And so instead we just see perhaps the NASDAQ moving sideways somewhat, and that's your correction in time, as money rotates into places where it makes better values. So I agree with everything you're saying. It's just a matter of perspective and where does the money go?
Yeah, that's a great point. And one last thing that we want to talk about this week is, even though it's a shortened work week, we've got the 4th of July weekend coming on Saturday and the markets are closed Friday, but we're going to have a couple big economic data points this week. Number one, on Wednesday, you're going to get the ISM Manufacturing Index, which is expected to come in below 50, which signals a contraction in the economy. Last month, it was actually at 32, which was terrible. And then on Thursday, we're going to get another look at the unemployment report for June. So it's the June jobs report coming Thursday, usually comes first Friday of the month. Jeff, remember last month, it surprised everyone. We were looking for a loss of 7.5 million jobs. It came in as a gain of 2.5 million jobs. Right now, we're looking for a gain of 1.5 million jobs. Any indication or any hint of how this could play out in the markets? Is the market priced in a beat, or what do you think we'll see on Thursday?
My attitude is I don't think you ever want to go, short or having low expectations into a major holiday. You and I have seen this far too many times. In many ways, it doesn't even matter whether the fundamentals support it or don't support it. The markets love major holidays, and with exceptions, plenty of exceptions, rally into them. And so, yes, I would expect that given the economic data that's on tap for Wednesday and for Thursday, since the markets are closed on Friday, I really feel like almost any excuse, any even minor data point within the broader report will probably be taken as great news and a chance to bid stocks higher. So I would not have low expectations going into this week, because I think this week will probably be a chance for a lot of the folks who felt like they missed out on the last run. Now's their chance in the next 4 days and maybe into the following week to sort of make things happen. If they missed buying Hertz before, now's their chance to buy Hertz a second time.
Yeah, it's funny. I agree with you in that we always see these low volume kind of moves, especially rallies around holidays. This year might be a little different because most traders have been in their summer houses since March, right? All the hedge fund managers moved out of the city when coronavirus hit, and they're all in the Hamptons, Martha's Vineyard, Nantucket, working from home. So maybe you don't have this phenomenon where they're in transit and the volume's low. Maybe they decide to trade right until, the close on Thursday for the first time, and we do see volume. So it might be a little different this year because everyone's already in their beach houses. So we'll have to see how that plays out. But it's hard to tell with these numbers. Last month, the economist estimate was so far off that it's like, how can you give any credence to this month? The one thing that we've been watching, and I want to just bring this up, check out this chart, open table reservations in different cities, because this is going to give you a forward look into how that particular economy reacts. And one thing you notice in the last week or so, we did have a spike up in seated diners in Miami, in Houston, and LA. And then we had the drop when that outbreak happened in those three states. We're starting to see it kind of creep up a little bit. And, we talked about this before our webinar. What do you make of that? We're starting to see a little bit of an uptick in some of these cities, even though that coronavirus is spreading to those cities. And how could this really impact the economy?
Yeah, I think overall, just taking a step back from the COVID-19 spike we've been talking about and all that, there is money coming into the economy. People are getting rehired. Businesses are reopening in either a limited way or a bigger way, depending on what industry and what part of the country they're in. But either way, the economy is reopening, and therefore there's money going out, and people feel better. When they feel better, they go out and eat. And so I feel like overall, yes, as you're pointing out, we should take that as a good sign that people feel confident enough to go out and eat and relax and not feel like they have to hunker down. Although obviously, for safety issues, hunkering down, or at least wearing a mask is a smart idea.
Yeah. And I think people are kind of assessing their own individual risks, right? If you're 20 years old, you're not going to be and you're living with a bunch of other 20-year-olds, you're not going to be self-quarantining yourself the entire summer. If you're 80 years old, you're in a different ballpark. You're probably still getting grocery delivery and not really going anywhere just yet. So I think it's kind of like a tale of two livelihoods, where people just need to take their own personal risk and understand what it means to them, and then evaluate their options. Do they social distance? Do they go out to a restaurant or a bar? I know a lot of states are shutting them down now, so that might not be an option. Or do they go to the beach and kind of sit or hang out with their friends where they could potentially expose themselves? So I don't know.
I agree. I think the broader point probably is not to get too negative on the economy or the market. If people feel good enough to go out and eat, they're feeling good enough to continue to spend in some way. And consumer spending being, the bigger chunk of the overall strength of the U.S. economy, it's a good thing going forward here. So
you summarized that much better than I did, Jeff. I think we should leave it there.
All right, I agree. For Ian King and for myself, all of us here at Banyan Hill, make sure to continue to subscribe to Smart Profits Daily. We'll see you next week.
And happy 4th of July.